Welcome back. The United States credit rating downgraded for the first time in U.S. history. Late last night, Standard & Poor's dropped the U.S. credit rating from the highest AAA rating to what they're calling AA+. So how will this affect the economy come Monday, and how will it affect the president? And let's talk about how it affects your wallet with our panel. It is a stellar panel this morning. Matt McCall, president of Penn Financial Group, Thomas Belesis, CEO of John Thomas Financial. You might have seen him in the movie Wall Street. And Dennis Neal, a correspondent for Fox Business Network. Good morning to you, gentlemen.
Good morning.
Big story. Matt, let me start with you. What does this mean to the American people's wallets? How will it affect them?
Well, I think what's going to happen is they're going to have more money in their wallets. And the way I'm going to get to this is because
More?
I'll tell you why. Because the confidence already was lacking in Americans right now. We've seen spending come back last month. People are saving more. Now, this downgrade takes that confidence level to a new low in my mind. So what's going to happen is Americans are going to be sitting on more money. The problem with this is if they go out to try to get a mortgage, they want to buy a new car, they're going to be paying more for that. So again, it goes back to them not spending. This crushes the consumer and really ends up hurting our economy.
More money only because they're spending
Only because
less.
they're not spending it, yeah.
Thomas, all the viewers out there want to know, AAA, AA, whatever, what does it mean to me? What's the impact?
Dave, this credit agency has no credibility whatsoever. This is the same rating agency that rated all the toxic subprime junk, AAA. So for investors to be concerned of this, I think they shouldn't. You have the best asset class in the world, stocks, trading at the best valuation in over a generation. So I think if they pick the areas that are doing best, the sectors that people want to buy, you'll get great prices here over the next 6 months.
Some dentists have suggested it's not going to be the calamity that some are predicting, that it won't ultimately kill your house payment, your car payment, your student loan, your small business.
This doesn't have to be the end of the world. Our entire political society now has to deal with everything in terms of it's a crisis, it's a crisis. But let's look at a couple things. Even last week, when we thought we were this close to the U.S. defaulting on its bonds, unable to pay, interest rates on treasuries were going down, not up, because people were flooding into them because they were still deciding that in a messed up world, the messed up USA is still the best bet to make. This does not have to raise interest rates at all. While they can set what they want to set, the market sets what it wants to set. And rates are at all-time lows. This doesn't have to hurt that much. But what bothers me about the whole move is why now? Why would an agency that thought mortgage-backed bonds with the worst credit-paying record from customers would be a great AAA investment, and now they're telling us Liechtenstein is a better place to put your money than USA. You know what? This is a face-saving move by an agency that is humiliated, and they did it to look good, and they did it even after the White House pointed out a $2 trillion error in math.
In 10 years. That is a massive math error. So across the board, you guys, every financial expert I've spoken with says, wrong decision. We define AAA rating. So
now,
why did they do it?
I didn't say that. I don't think it's necessarily a wrong decision. Let's think about it. If you got a family earning $100,000 a year and they had $40,000 in debt, but now they have $100,000 in debt, they deserve to go down from AAA to AA+.
But Dennis, you're putting them in the same level as Slovenia, Chile,
is political and face-saving, and really give me a break.
Okay, so there's a little gray area.
It's supportable financially.
Why'd they do it? They're
doing this because I think they almost have a political move in mind as well. S&P, they're saying, listen, government, wake up. We're on the path to becoming AA rated. But I think they're kind of jumping in. You know, it's like somebody who's sick. Instead of letting them get sicker, they're giving them medicine right away. The tough medicine saying, get your house in order right now. Which I don't think they have the ability to do that. So that's why they did this.
Thomas, who is the S&P to weigh in on our political situation?
They have no merit whatsoever. I mean, let's look at the S&P and what they did to Japan a long time ago. They downgraded it. It had no effect on interest rates nor the economy. And it was still a great time to buy stocks back then. So if you look back now and you look at the valuations of the market, this is a great time to buy U.S. stocks in this economy.
That is the irony of the super sell-off of over 500 points on Thursday. A guy told me, he pointed out, 1990 versus now. In 1990, stocks were more expensive than they are today. They're less than 14 times trailing earnings today. And treasuries were paying 8.6% interest in 1990. Today, people are selling out of stocks, which are cheaper than they were in 1990, to get treasuries paying less than 2.5%.
Yes or no, the Dow crashes Monday? Markets crash, yes or no?
I think early morning, we get crushed, but we close up by the end of the day.
Yes?
No, I don't.
No.
I don't think we get crushed at all because I think this is already baked in.
All right. Great panel this morning, guys. Matt McCall from Penn Financial, Thomas Belesis from John Thomas Financial, and Dennis Neal from the Fox Business Network. Great stuff, guys. More Fox and Friends in 2 minutes.